If you're a business owner or real estate investor who's tired of hearing vague tax advice like deduct more stuff or buy more equipment, keep watching, because today I'm walking you through 3 specific tax strategies that have saved my clients over $100,000 combined in a single tax year. Not theory, not this might work, actual returns, actual savings, actual math. The 3 strategies are cost segregation, the Augusta Rule, and the accountable plan. Here's the bet I'm making. You already qualify for at least one of these. You just don't know it yet. Most entrepreneurs think wealth is built by working harder or earning more, but real wealth is built by controlling how much you keep. The tax code is not an obstacle, it's a rule book. And if you know how to read it, you can rewrite your financial reality. So let me walk you through each one, what the tax code actually says, how the math works, the myths that trip people up, and real case studies from my own practice. Let's get into it. First up, cost segregation. Now, if you own commercial real estate or residential rental property, this is the strategy you're most likely leaving money on. Because most CPAs will depreciate your building over 27.5 years for residential or 39 years for commercial and call it done. That's standard. But standard is often just a fancy word for missing opportunities. But here's where it gets good. The tax code allows you to break a building into its component parts, and different parts depreciate at different speeds. The building shell, 27.5 or 39 years, but the carpet, 5 years, the appliances, 5 years, the landscaping, 15 years, the parking lot, 15 years. What cost segregation does is simple. It identifies the assets inside your building that can be reclassified from building to personal property or land improvements, and those assets get depreciated over 5, 7, or 15 years instead of 27.5 or 39. The result is massive acceleration of depreciation in the early years, and since depreciation reduces taxable income dollar for dollar, this is real savings. You are shifting tax liability from now to much later, which is the cornerstone of wealth preservation. Let me make this real. I had a client, let's call him Marcus, who bought a commercial building for $1.2 million. His CPA set it up on a 39-year straight line schedule. That gave him about $31,000 in depreciation per year. We ran a cost segregation study. The engineering firm identified about $280,000 in assets that qualified for 5-year treatment and another $190,000 in 15-year land improvements. The remaining $730,000 stayed at 39 years. Here's what happened to his first year depreciation. The 5-year assets, $280,000, bonus depreciated 60% in year 1, that's $168,000. The 15-year assets, $190,000 at roughly $12,700 in year 1. The building shell, $730,000 at roughly $18,700. Total first-year depreciation under the old method, $31,000 under cost seg, just under $200,000. That's an additional $169,000 in depreciation. At a 37% marginal rate, Marcus saved over $62,000 in taxes in year 1 alone on a property he was already going to own. Now, the myth-busting part, I hear people say, but wait, doesn't this trigger an audit? No, this is a sanctioned engineering study. The IRS literally provides the guidance for how to do this. It only triggers issues if you do it lazily. 1, you need an actual engineering study. You can't just make up component values. The IRS requires a qualified cost segregation study performed by experts. 2, there's depreciation recapture when you sell. So this is a deferral strategy, not a permanent elimination, unless you do a 1031 exchange, in which case you can keep deferring. And 3, this works for properties you've already owned. You can do a look-back study and catch up on depreciation you missed without amending prior returns. You do not need to be in the year of purchase to make this work. That's cost segregation. Let's move to strategy number 2, the Augusta Rule, section 280A of the Internal Revenue Code. Here's what it says. In plain English, you can rent your personal residence to your business for up to 14 days per year, and the business gets a deduction for the rent paid while you, the homeowner, receive that rental income completely tax-free. You don't even report it on your return. This isn't a loophole. This is literally written into the code. It was originally designed for homeowners in Augusta, Georgia, who rented their homes during the Masters golf tournament, but the code doesn't say only during golf tournaments. It says 14 days, period. So here's how it works for a business owner. Your S Corp or LLC holds board meetings, strategy sessions, or team retreats at your home. The business pays you fair market rent for those days. The business deducts it, you receive it tax-free, that's it. Now, I see people mess these up constantly because they treat it like a free money trick rather than a tax strategy. Rule 1, it must be fair market rent. If you charge $50,000 for one day in a house that would rent for $500 on Airbnb, the IRS will disallow the entire thing and likely audit you. Pull comparable rental rates, keep them on file. Do not inflate your market rent. Rule 2, there must be a legitimate business purpose, a board meeting, a strategy session, a team retreat, not I worked from home today. Document the meeting, minutes, agenda, attendees. If there is no documentation, there was no board meeting. Rule 3, 14 days is the hard cap. Day 15, that rental income becomes taxable. Run a 14-day calendar and don't exceed it. Let me give you a real example. I have a client, I'll call her Jessica, who runs a marketing agency as an S Corp. Her home would rent for about $3,000 per day based on comparable short-term rentals in her area. Nice house, but not a mansion. We set up quarterly board meetings, that's 4 days, plus an annual 2-day strategy retreat. 6 days total, well within the 14-day limit. 6 days at $3,000 per day is $18,000. The S Corp deducts $18,000. Jessica receives $18,000 tax-free. Now at her effective tax rate, that $18,000 in tax-free income is equivalent to about $27,000 in W-2 salary. Add in the fact that the S Corp is also reducing its taxable income by $18,000, and her total tax savings across entity and personal is roughly $14,000 to $16,000 per year. That's one strategy, properly structured, saving 5 figures annually forever, as long as the rules are followed. The biggest myth here, that you need a giant luxury estate to make this work. You don't. You need a home that is comparable to local short-term rentals. If your home is modest, your rent will be modest, but the strategy is the same. Do not try to force this into a shape it doesn't fit. Strategy 3, the accountable plan. If you operate as an S Corp, this is probably the single biggest miss I see across tax returns. And the reason is simple. Most CPAs set up your S Corp tell you to take a reasonable salary and never mention that the expenses you're paying out of pocket could be reimbursed tax-free through the entity. Here's the problem. When you pay a business expense personally, your home office supplies, your mileage, your cell phone, your continuing education, and you don't get reimbursed by the S Corp, you're in a terrible tax position. Those unreimbursed employee expenses are not deductible on your personal return under current tax law. So you're paying for business costs with after-tax dollars. That's leaving money behind. An accountable plan fixes this. It's a formal reimbursement arrangement where the S Corp reimburses you for business expenses you pay personally, and those reimbursements are tax-free to you and deductible to the corporation. The IRS requires 3 things for an accountable plan. 1, the expenses must have a business connection. It's not just home office. It's mileage. It's 100% of business-related travel. It's 50% or 100% of business meals, depending on the situation. It's continuing education, books, equipment, internet, all qualify if they serve a business purpose. 2, you must substantiate the expenses within 60 days. That means a receipt, a mileage log, a documented business purpose, contemporaneous, not reconstructed. If you come to me in April with a shoebox of receipts from last June, you have failed the accountable plan requirement. 3, if the S Corp advances you money and you don't substantiate it, you must return the excess within 120 days or it becomes taxable compensation. That's it, 3 requirements, and the payoff is a deduction on one side and tax-free income on the other. This is about capturing the expenses you are already paying but currently receiving 0 tax benefit for. It's an efficiency play. Now, here's where this gets interesting. And this is what separates a bookkeeper from a tax strategist. These 3 strategies don't compete with each other, they stack. Take a real estate investor who also runs an S Corp. Cost segregation accelerates depreciation on their properties, 6 figures of deductions front-loaded into year 1. The Augusta Rule moves $18,000 to $25,000 from taxable to tax-free through board meetings and retreats. The accountable plan captures every home office expense, every mile driven, every phone bill, every conference, all reimbursed tax-free through the entity. Individually, these are good strategies. Stacked together, they can save a high-earning business owner $100,000 or more in a single tax year, not through gimmicks, through the tax code working exactly as written. The sequencing is important. You want to ensure your S Corp salary is set appropriately to accommodate these deductions and that your real estate assets are positioned correctly to maximize that depreciation. This is why you don't just do tax strategy, you design it. And that's the point I want you to take from this. None of this is hiding anything. None of this is aggressive. This is the tax code. Read it, use it. That's what it's there for. If you are not utilizing these, you are essentially making a voluntary contribution to the Treasury, and that is not a financial strategy. So here's what you do next. Ask yourself which of these 3 applies to me. If you own real estate, cost segregation. If you own a business and a home, the Augusta Rule. If you operate as an S Corp, an accountable plan. If you're nodding yes to more than one of those, you're likely leaving six figures on the table right now, and that money could be reinvested into your business, into your portfolio, or into your own retirement. I walk through the exact structuring of all three of these in my book, Your Biggest Expense. It's linked in the description, not affiliate fluff, the actual frameworks I use with my own clients to design these plans. Now you know the math. Now you know the code sections. Now you know what to ask your CPA for. Stop guessing with your wealth. As always, thanks so much for listening, and keep more.